Thank you everyone for joining. This is Sam Tucker, Group CEO of Perfect Group of Companies. And today's webinar, we are going to do a little differently. It's going to be an interesting mechanism where we are going to go over the presentation quickly, and then very soon we'll also show you how to technically, work on, how technically this planning could help. And we'll also create a scenario, one-on-one scenario, where we would technically, share the screen and run some scenarios for different people. There is some technical difficulty on my end. I hope you guys are able to hear me out. But as I said again, we're going to go and quickly get started today's webinar. And today's webinar is focused towards planning and how clients could maximize their day-to-day deductions. What are the opportunities, what they can do to maximize the benefit, and how they can pre-plan before end of the year to maximize their savings for their tax planning. So I hope everyone is able to see this thing. Perfect Group started business in 2002. Group is named as one of the fastest growing small business by US Chamber of Commerce and Inc. 5000 magazine in 2016 and 2020. Perfect Group of Company adds value to all ventures due to its expertise into tax planning and risk management. And we have expanded in real estate development, media, hospitality, entertainment industry over the last 10 years. To give a quick synopsis, Perfect Group is divided into three different buckets: media, entertainment, and hospitality, which is again divided into radio, digital media, theater, food and entertainment, and concerts and events. Real estate includes residential, commercial, and land development. And tax, finance, and real estate accounting would be in the federal tax return, high net worth individual, corporate and individual tax planning, CFO services, and real estate incentive tax planning as well. So this gives you again the same synopsis how Perfect Group of Companies, all the companies, work in adding value to our clients. These are the diversified services we provide to our clients, right from individual tax return services to marketing, to catering, to media and entertainment, to real estate, depreciation planning, tax planning, foreign compliance planning, IRS audits, contract draft reviews, capital gains tax planning, life insurance. A lot of people ask me this question that I have CPA and I'm happy with the CPA. Why should I do tax planning? And I always tell them that what is the key difference between a CPA versus tax strategist? Ironically, most of us turn, if you need any tax advice, you turn to your CPA. Now, no offense to our CPAs, but their job is to figure out to pay taxes, not to figure out how to not pay taxes. So a lot of people are still using TurboTax, hoping that somehow the program will maximize their savings. But I don't understand that how can the information we plug into, how TurboTax will magically know all our extenuating circumstances and help us save money. In software world, they say it's GIGO, garbage in, garbage out. So softwares are only dependent on inputs what you supply. Tax planning are not based on the input. Tax planning are based on circumstantial benefits which could be created, which could advantage a client. And that for someone that it is not determined based on the input data, but it is based on the situation individually of client or what it could be created. So, obviously tax strategies are, needs to have a combination of knowledge of taxes, needs to have combination knowledge, so our tax strategist or tax planning firm needs to have, CPAs, enrolled agents, attorneys who really combined can help you. Sometimes, fee wise, the tax strategists don't cost you anything. Your CPA might cost you $1, but fee wise, your tax strategist ends up being your profit center. We have full-time tax strategists on staff, including, attorneys. As we set up the structure, we are now positioned to take advantage of these laws before end of this year. Our business model is very simple. We keep customer value creation in the center and build products around it, including core products, complex products, innovative products, and compliance. So as I told you, example, how many of you know a popular strategy that, if you have a work from home, then you can technically take deduction of your house. But a lot of people also understand that you can only deduct for the size and area of your home. Let me ask you a question. Is there a strategy you can create where you can deduct your entire home? Yes, you can. Example, IRS Section 280G. You can create where you can rent the entire home to your business, where the business pays income or income to the individual, and individual would not have to report that as an income in his personal tax return, but they are still able to deduct that as an expense under Section 280 AG. FICA tax reduction using an S corp, income shifting from college, from your individual to minors or your kids. Now that could be somebody could argue that that is a popular strategy, but you need to remember that strategy nobody tells you or teaches you that if technically IRS tomorrow audits you, how will you justify your kid who is not even living with you if he's in college that you are paying him expenses? Or how will you deduct your minor, possibly who does not have an experience and background, to that you are paying him or her salary? In our strategy, we keep that in mind. We are not technically using any of those out of the box cookie cutter solutions where you could be prone to audit. We go on assumption that every client could be audited, and we need to design our strategies keeping lawful strategies in mind, and such a way that technically, even though we are audited, we could technically, IRS could not technically penalize you because they're done lawfully. Example, under Section 280G, we can comfortably set aside $28,000 a year without tax, without paying any taxes on that. So if somebody is making an income of, 300K, $28,000 means that, close to 30% tax bracket. So now you can save technically close to $10,000 in taxes by just one sample strategy alone. Income shifting, I give you an example. We can shift income such a way that technically you don't have to justify your kids are working in the business, and at the same time they can use this income to pay for their kids' education cost, including college education cost. If you put money into 529 plan, it only saves you state income tax. Versus with this strategy, you can technically deduct the full expense of the college which you are paying to your child. So let's call us and try to understand that how we can maximize this strategy lawfully. Supreme Court has ruled multiple times that anyone may arrange his affairs tax to be taxed lowest lawfully, and he is not to choose a pattern which advantages treasury, and he has no patriotic duty to technically pay higher taxes by not using lawful tax strategies. Moving income from high tax state to low tax state. So if somebody technically is making, we had a lot of clients who are making income in taxable state. Now this year they say that if Democrats win, the taxable income in states like California and New York, the topmost tax bracket you might look like is close to 63%. So what can you do to save taxes? So it is how you can move your income from high tax state to low tax state. Changing the character of the income, how you can convert your income from ordinary income to qualified dividend income. I would give you an example. I was dealing with a client recently, and that client has a short-term capital loss. But as you know, that capital loss is deductible only over maximum up to $3,000 a year against your ordinary income. So if this client has over $100,000 loss from the short-term stock trading or any of the transactions, he is only able to take $3,000 deduction against his W-2 income or other income. So if he follows the normal strategy, it would be before 30 years, he would be able to deduct the entire losses. What can you do to technically write off that expense this year versus, waiting for 30 years? We can help you, change the character of your income such a way that your capital losses are offsettable or adjustable against your ordinary income. High tax percent to low tax percent. So as I told you again, so high tax percent, real or artificial, and artificial means it could be corporations, it could be CS, LLC, single member, or trust. How can we take advantage of other tax structures and move the income from you individually to low income tax structures, which could be a real person or artificial person like entity structure like S, LLC, C, corporation. High tax period to low tax period. Everyone knows that next year, if Democrats were to win, then the tax rates are going to be high. Now, could you do it such a way that you move your income from next year to this year? And we have helped a lot of clients where they have one-off income. Either it is high in this year and he wants to distribute his income over next 3 to 4 years, or vice versa, his income is high next year and he wants to prepone his income in this year. We can do that as well. Charitable planning. A lot of people know that when they donate the money, they can write off tax losses. But a lot of people don't know that this year is a unique year where government has allowed your tax reduction dollar to dollar up to 100% of your income. So you can not only deduct the income, but you can deduct up to 100% of your income as a charitable deduction. Now, a lot of people say that, hey, I would like to deduct that, but I'm not decided where to give charity this year. And I don't know if I want to allocate all the money to charity this year, can I still keep the deduction and technically decide over the years how to maximize the charity? Yes, you can. You can phenomenally use a strategy which is legally lawfully allowed in IRS section codes, which is called donor advised fund, where you can allocate the deduction to this year and take the deduction this year, but you can technically decide how much to give to charity over next 30 years while you are growing your asset as well. That way you can keep more money and technically maximize your value for yourself. Example, a client who technically is transferring money into an LLC, he could donate this LLC to a donor advised fund or give it to donor advised fund, giving him maximum deduction and at the same time maximizing the charity and keeping more money with you individually as well. What are the purpose of charitable goals are containment of giving, liability protection, control over charity, control which charity to support, better cash flow, and managing the investments. So this is an example of someone not doing charitable planning. If they had $100,000 in income over like 10 years, or $100,000 taxable income, then he would pay a tax liability of give or take about 480K, including state and federal tax together. If you properly structure this with the charitable planning, you see that by 45th year, with the charitable planning, this individual is walking away with $12 million versus without the plan and paying taxes, this individual has $6 million. So you are able to save $6.5 million more. Energy tax credits. This is a great year. Your last year tax credits were 30%. This year tax credit has been brought down to 26%. Next year it is planned to be brought down to 22%. So I say that this is one of the best year to maximize your charitable goals before, or your energy tax credits before it goes down. So what do I mean by that is that if you were to invest $1 in your solar investment, can you invest such a way that you get your returns on your money from the tax refund and tax credits which exceed 30% per year, and it also maximizes the value for you. So you can technically create a scenario where you can create solar tax credits, invest into solar tax credits this is not by installing solar on your roof. This is by investing into solar farms where you are able to get money back in less than a year from IRS. At the same time, you are able to maximize your returns as well. So how does it work? So whatever you invest, let's say you invest $100,000, you are able to get all the money back from your tax credits. That is, full $100,000 comes back to you in form of tax credits. At the same time, any extra depreciation would bring your ordinary taxes down because depreciation could offset your other income. Example, somebody with doing a solar tax credit is able to walk away if this individual owed $100,000 in taxes. After proper planning of solar tax credit, he is able to walk away with an additional $33,000 in his pocket. Net of expenses, he's able to walk away with $20,000 in his pocket. So he literally gets, in this scenario, 21% discount on his taxes. It's almost like buying a group one of taxes. So I always say lock your benefits before it's too late. Important thing in this scenario is to do things proactively. So today we are going to do one more thing. I'm going to invite Ankit to share the screen where we are going to take an example and plug it into software to see that how a client making about $300,000 income can maximize his saving. So what I would like to do is, I would like to technically invite Ankit to share his screen. Give me 1 second. It will take me 2 minutes to switch the screens where Ankit can technically, share his screen. Thank you, Ankit.
Hello, everyone. All right, Sam. So
if you can, Ankit, show a scenario of, this is a tax planning tool. Any client that walks into our office, what we first do is we try to create what if scenarios. And what if you were to implement certain strategy, certain analysis, how do you think the cash flow would look like? So Ankit, if you can give us an example that if someone had a 1099 income of $150,000 and a W2 income for his spouse for $150,000, total income of $300,000 with 2 kids, how do they advantage from investing into things like, or doing things like green energy investment, solar tax credits, and maximizing the donor advised fund activity, and at the same time maybe doing some simple planning as well. If you show me 3 different scenarios where they're just doing simple planning, then they're just doing the the green energy, and they're just doing the charitable, or maybe you can show me one scenario where they're doing all 3 of the scenarios and what it would maximize to. Show me 3 scenarios. So Ankit is going to create a baseline plan where he will show us that what is his tax liability for someone who is on 1099 with a family making $300,000 income with 2 dependents. Bear with us. Anyone has a question, please ask your questions on input window on your chat screen. You can click on that and we would try to answer your questions on that. So Ankit is just creating. Ankit, if you don't mind, just combine the plan into one single plan. Let's just show all 3 combined together. What is the benefit we are getting? So bear with us while Ankit is technically plugging in the numbers. As I said again, in the meanwhile, what I'm going to do is, let me see if I can technically. Will you cover LLC business tax planning also in today's session? Yes. So that is what we are technically doing right now. What we are doing is we are taking a scenario of $300,000. See, there are 2 things. There are 2 jobs, or CPAs have to maximize your tax reduction. So yes, Atul, we would technically make sure that you are able to maximize your tax reduction. But at the same time, we are going to show you that without deduction, if you were to maximize some of the strategies which we just discussed, is there a potential for us to get advantage of that? Ankit also show that 280 AG deduction as well, that if they were to technically claim the $1,500 a day for the home office or for renting the home to individual, so that is about 14 days. I think you can do that. So it's 14 into $1,500, so about $21,000 in deduction. Just to give you a little bit of an idea, I have clients who have had income of more than $2 million, but they pay less than $25,000 in taxes lawfully because they are maximizing 4 different strategies. They're maximizing their planning, proactive planning. They're maximizing their, rebalancing the income between all the family members. They are also maximizing the, green energy tax credits. They're maximizing their charitable tax benefits by using the donor advised fund, and at the same time they are also maximizing things like 280G deductions and other deductions. So it is very, very important how to take maximum advantage in this scenario. Ankit, just in the simple plan, combine all 3 scenarios together.
okay.
Yeah, you can delete the separate scenarios and we can just focus on one. So while Ankit is doing that, so Ankit, while you're doing that, what I'm going to do is I'm going to switch the screen. You plug in the numbers, and then when you're ready, I'll let you technically share the screen back again.
Almost ready.
You're almost ready?
Yeah. So I have plugged the simple planning, the charitable deduction of 75K, and the solar and then solar credit about 13,000.
Okay. So can you show the scenario 1? If you see here, with someone 300,000 income, was total paying a tax liability of 46,937. Ankit, the self-employed tax should be higher. It's 1099. So there is something missing here. It's a 150K income.
Okay. Yeah, because the same person also has a W2 income.
No, it's a spouse having W2 income. Sorry for that.
Okay.
You might have to make that change. So this example here is the spouse has 150K W2 income and he has a consulting LLC / 1099 kind of an income. Now this is without any extra expense deduction. We are assuming that this 150K business income is net of deduction. Excuse me.
Okay, it is corrected now.
Okay. So if you see in this
One
scenario,
more thing. Sorry, Sam. One more thing. Sorry.
so while we are waiting, anyone has any questions, please feel to ask questions in Q&A window or chat window. So here, I think there is a question that, if AGI is combined 400 to 500K, majority of the W2, I do have a business which is in startup mode for 2 years and not producing any income. Any strategies to reduce tax liability? Yes. So some of the strategies which we are showing will be applicable in both the examples. So what I'm going to do is next, while Ankit is going to continue doing a scenario for that 500K income, I would continue showing other things on the screen while Ankit can rework this scenario. So let us first go through this, where it is a combination income of 150K W2 and 150K business kind of an income, which is on LLC or 1099. So here you see in this option, people who are technically doing just as is plan with the income, they are paying about $62,373 in federal taxes. This is after all the QBI deduction, itemized deduction, standard deduction and adjustments and everything combined together, including this social security tax, Medicare tax, federal tax on the 1099 income or LLC income. If you see with the plan, we are able to go down to $7,065 in taxes. So if you really compare both the plans in this scenario, the per individual is going to save close to $55,000 in taxes. Now, this is a phenomenal strategy where you'll be able to leave a lot of money for charity. At the same time, in this example, save over $55,000 in tax liability. So anybody who is technically, in this bracket or this kind of combination, this strategy is working phenomenally well for them. Ankit, what I'm going to do is I'm going to share my screen. In the meantime, you please rework a scenario, create another scenario where the scenario is focused on 500K W2 income and zero business income. Maybe you can put $5,000 business loss because there's no income. So I'm assuming there's some business loss because of some expenses claiming. So go ahead and put that business loss expense claiming and show me a strategy where we are able to save money. And this is 500K W2.
And again, all three combined.
All three combined. That's an AGI of 500K W2.
Okay.
All right. While I'm sharing my screen, I'm going to share my screen while Ankit is working on that scenario, so we can show you, a couple of other things while we come back. So what we do is, this is another planning tool. I'm going to create and show you. So when a client comes in, what do we do? So I'm going to just put test client, test 1, 2, 3, 4, 5, 6. We create a summary for each client coming in. Once you engage us, every year you would be doing this thing for you. This is a comprehensive custom text planning tool which was created by us, where we would add him as a married filing joint, we would add a spouse, sample wife. I like that. Married filing jointly, we would say he owns a house, saving for college. Okay, so we put own a second home. So this is somebody who owns a second home. Current income and taxes, we'll put in about, $300,000 income, same example. Taxable income is also 300,000. We'll put in 285K. Self-employment tax, we'll put in $21,000 in previous example was there. Taxpayers annual W2 income, 150K. Sorry, it's a spouse income, so I'm going to put that in spouse's income. We'll try to see if we can do so. Let's say we are doing 401k plan. We'll get to another window. We'll add a business. Ownership is 100%. We would say business revenues are $200,000. Net income is 150K. Specified service business is a consulting business. Let's say business occupies a home office. We would select that as a LLC. We put primary owner's salary as, let's say, $50,000, or let's say $100,000. No business benefit plans we today have. Investment information, we manage, traditional qualified IRA assets, hold taxable cash or equivalent CDs, hold $100,000 plus gain in your portfolio. So we choose $100,000 plus gain in your portfolio. Own investment real estate, qualify as a real estate professional. We'll create a report in this scenario. We'll create select a mini plan. So we'll use this plan. We'll use some of those things. I'm choosing some of the strategies. We will take a state income tax also. We will choose California in this example and run the report. We'll generate the report. So it takes a little bit of time because it is generating over 100-page report and recommendation. So whenever a client comes in, we go through this detailed analysis, which your software is not looking into it. Your software or your CPA is focusing only on maximizing the value for deductions. So in this example, you see that we have technically created a detailed plan which exceeds close to 200 pages. showing you the IRS section code of each and everything. I'm just going to zoom it a little bit. It is going to tell you, tax saver is going to tell you how you can save taxes, how much you can save. It gives you a little bit of background and analysis. I'm going to skip some of the strategies. It gives you an idea of what you can do and how you can save money. And it gives you a section code. What is your advantage? What could be your savings in a layman terms? It will also tell you how to maximize the value. So this is what we do going forward. This is a new thing which we have just implemented this year for all our clients. So going forward this year onwards, we would technically give a 200-page report, which is, and every year we do this report, which technically alone, you know, we have invested hundreds of thousands of dollars to develop softwares like this, which technically gives a maximum value for, so it's not a book that you're buying in Google or somewhere or Amazon. This is where we are customizing. You see your potential savings right here. On every page, it will tell you wherever the potential saving is there, it will tell you like this particular strategy, this is the potential saving. It will tell you your potential saving in every example. It would give you a charitable lead trust, donor advice fund. And then if you decide for us to implement this strategy, it would also help you implement all of the strategy. So we're not only going to show you how to do it and give you a detailed tax code, section codes, where it is broken up into, how it is broken up into, but we would also help you implement it as well. Ankit, I'm going to switch gears to you back. Before I present the last part of the session, I want you to show what else, you know, in this scenario we can do. And, you know, this is for the scenario where there is a $200,000 or $500,000 income.
Yeah, so 5,000 income with the business of 5,000 loss. So the EGI drops to 495. That's a base plan. And then we have maximized some benefit through the simple, charity, and solar.
Yes. So in this example,
here is,
what is the total taxes, Ankit, if you can show me? What is your federal tax? So without the plan, you are technically going to give or take pay taxes of $116,340, and this is without state income tax. With the plan, how much is the net taxes they are paying? They are paying $88,521. So the person who has asked me this question, Vic, in your scenario, you see you can save over $102,000 in taxes. See, people think that only Donald Trump or, you know, high net worth individuals can do tax planning. You know, you see that proper proactive planning lawfully could be done by anyone. This is an excellent example that if you save yourself $100,000 a year, that is your single largest expense. You do this for 10 years and reinvest that savings into different, you know, making you an 8 to 10% a year, you would see that the amount of savings when you retire would exceed in millions of dollars. So this is an excellent example. As Ankit mentioned, I really appreciate it, Ankit. So, you know, this technically gives you a lot of information, you know, which helps them. So typically to review this plan, in order to review this plan, it does not cost you anything. To do a detailed plan, which I just gave you earlier, that cost is $2,500. We charge $2,500 for that. And then implementation fee is extra based on what strategies you implement. If you self-implement the strategies and if you feel comfortable implementing strategies yourself, then obviously there are no fees. You can self-implement that. But if we were to help you implement some of that strategy, that fee would be extra costing that. But remember this thing, that we are profit center. In this example, even if you were paying $10,000 in fees or $15,000 in fees, you are going to still walk away with a net saving, give or take, of $80,000 to $90,000. So at the end of the day, in my opinion, the tax strategy ultimately gives you, it's a profit center, not a cost center. So it's a profit center. So I strongly recommend everyone to explore this strategy and not miss that opportunity. Every week we take different scenarios, different case studies. I'm going to show you the last part of the session because that is extremely important as well. Give me 1 second. I'm going to share my screen. Thanks, Ankit.
Thank you.
Another big, great strategy a lot of people don't realize is investing into depreciation generating assets. I hope you are able to see my screen. Let me just confirm that everybody is able to see my screen. Skip to the slide. Give me 1 second. Okay. So what to do, where to invest? Today, everyone says that, if Democrats win, emotionally, there should be some market correction. What I tell people is that invest into assets with generative depreciation. So right now, Perfect Group Holding is creating a fund which is going to invest into assets which are AAA rated assets, which are owned by Fortune 500 companies. I would give you an example. One of the assets we have put under, we have right now submitted a letter of intent in this fund is a training facility owned by Walmart. It's a 45-minute training facility owned by Walmart or rented by Walmart, where we have 8-year lease, a new building which was recently constructed. And in this fund, we would have similar multiple different assets. Now, we are not yet, purchase out this thing. So as part of this fund, I'm, not every letter of intent we submit would close on that asset, but we would close on very similar assets. And example assets are, Fortune 500 company owned warehouses, office, retail centers. Also, 20% of the asset of this fund would be invested into mezzanine debt. Combined between mezzanine debt and 80% of AAA rated assets, which are owned or rented by companies like Microsoft, Verizon, Walmart, T-Mobile, and those companies, we are going to produce 6% cash on cash return for all the investors. And if you invest above $500,000, you do get eligible for depreciation also. Actually, above 250K, you do get eligible for depreciation as well. Depreciation would bring in, so if somebody is investing on 250K, you are going to get, give or take, about $100,000 back, little less than 100,000, about $90,000 to $80,000 back in form of tax savings. And we would give you 6% annualized rate of return paid every quarter. So you're getting returns, quarterly returns, 6% a year. You're getting, a depreciation benefit of $100,000, which would technically make your returns to be closer to 12 to 14% a year. And then on top of that, anything more than 6% that company fund makes, we would split the profit share 50% with you in the proportion of whatever you have invested. So this is an excellent example of an investment fund which is generating your tax savings by depreciation, which would also generate you. I think Vic is asking, does 6% cash on cash exclude the depreciation benefit or including? No, 6% cash on cash is a cash benefit and depreciation would be additional benefit to it. So if you average out both of them combined together, you are looking at technically give or take about 10 to 12% return plus the profit share at the tail end, which would combine together, which could convert your average return between 12 to 20% a year. So you get three profits. You get your annualized cash on cash return, which is 6%. You get depreciation, which is per year, and you get exit profit when we actually sell that asset in 3 to 5 years. When we sell that asset, because there is a rent escalator, when we exit, we make higher money. So now you got three benefit. You got, tax deferment because of depreciation. You got your cash on cash benefit, and you got exit profit. Exit profit, anything more than 6% we have generated, we technically charge 2% fees. Anything more than 6% we have generated, we divide that benefit 50-50 with our investors in this fund. So what are the risks of, somebody's asking me question, what are the risks of this asset losing value? So great question. 80% of this money is invested into AAA rated or BBB plus rated assets, which are companies and corporates which are billions of dollars in profits or value. So we are not investing into assets or companies which are not doing good. Example, companies like Microsoft, Apple, Walmart, that those assets are gold standard assets. They're as good as your bank CDs are. First thing. Second thing is, on top of that, 20% mezzanine debt which we do of this fund, that asset is also, we are doing a 50 cents on a dollar investment. So if someone has an asset of $100,000 or $1 million, maximum we will lend them is technically $500,000. If somebody has $1 million asset, we are only going to lend them $500,000. And average return on a mezzanine fund average is between 12 to 16%. And that is why, if you're doing a leveraging of 2 times, you would be okay. Your assets would be safe. Your fund would be safe. We have invested into multiple these assets from years, and we have not lost 1 cent for us and our investors, also generating tax efficiency and depreciation. So this is an excellent example of technically making this money. What makes the particular fund investment qualify for depreciation versus a typical fund investment? So in typical fund investments, they are only giving depreciation to sponsors. Here, as a benefit, we are distributing this, the benefit to anyone who is investing more than 250K. So it is the fund sponsors benefit, how they distribute it out. Typically fund sponsors, what they do is, and you can perpetually not pay taxes, because at the end of 5 years, what you can do is when you sell the asset, you can technically don't have to recapture the depreciation, because we can comfortably do a 1031 exchange into another asset. If you only pay tax on depreciation if you were to cash out. If you were not to cash out, and if you were to reinvest into another similar asset class or similar asset fund, then this you would technically defer your taxes, and then when you leave this asset to your family members as inheritance, that becomes a tax-free transfer to your family members. So this is a phenomenal example on top of other strategies that how Perfect Group Holdings also is innovating investments which are tax efficient, and they're safe investments as well. My recommendation is, if you would like to know more about any of these things, technically call us, talk to us. This fund size is a $50 million fund size. You can invest from your 401k, self-directed IRA, donor advised fund, savings or checking account, or brokerage account. This is just an example of different classes of stock which this fund would have. This is a group leadership team, which is myself, Sam Tucker. I act as a group CEO. Purvesh Tucker, who acts as a CEO for Tucker Developers, and Vaishali Tucker, who acts as a CEO of Phanesia Dallas, and she also acts as a CEO over the concerts and events and Perfect Tax. Dheeraj, who was an ex-Z CEO, Mohammed Qasim, Sam Sayani, and David Pagan. So we have a phenomenal team. Where do you get from here? You can maximize your cash flow through charitable planning, secure a solar tax credit today for 2020 before it runs out. Typically every year, solar tax credits we run out at the end of the year. Restructure your income through advanced tax planning and invest efficiently. If you want, please call us back or text me at 214-454-7230, or you can email to us at info@perfecttax.com, or you can also text Ankit up on his phone at 469-855-5690. You can call Ankit or text Ankit at 469-855-5690, or call me at text me at 214-454-7230. Thank you everyone for joining this session. Next week again at 3 p.m. we'll dial in with some new topics, some new information before end of the year. Keep tuning in. We'll keep bringing you. Next week we would show you a scenario like today, a different scenario. At the same time, we would discuss that how someone could pay zero short-term capital gains tax from stock trading or equity trading or any kind of capital gains taxes, and how they can sell their asset or real estate also with zero capital gains tax. Looking forward to talk to you again next week. Thank you everyone. Have a wonderful afternoon. Again, I always say the difference between somebody who does this thing and takes the leap of faith is someone who takes this first action plan. You cannot save this money beyond December 31st. You have to start your tax planning. This is the perfect time to start your tax planning. Email or text us at 214-454-7230. Thank you very much, Ankit, as well, and the entire team of Perfect Tax. Thank you very much.